Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we are talking about the tax rules for companies that own private aircraft. In February, the IRS announced a program to start auditing personal use of company-owned aircraft, really targeting company owners and key executives. This continues IRS recent actions to step up examinations on high net worth individuals. Joining today's conversation is Mike Grimm. Mike is director with our state and local tax team, specializes in resolving controversy issues between taxpayers and tax authorities, and also has extensive experience working with company-owned aircraft. How are you doing today, Mike?
Good, Brooks. Appreciate it. I'm sitting here. I'm resident in the Louisville, Kentucky office of Cherry Beckert, and looking forward to today's topic.
And I think you were saying earlier there might be a horse race somewhere near you in the next day or two.
Yeah. There's a certain 2.5 minutes that is getting a lot of worldwide attention here for the next couple weeks, or at least the rest of this week. So it's a lively time to be in Louisville. I can tell you that.
All right. And as always, my partner in crime joining me today, Miss Sarah McGregor from Greenville. How's life treating you?
Life is great. Glad it's May. Glad we're on to summer topics and summer things to think about. And I was just thinking about all the private planes probably flying in to Louisville for that race. And perfect time to be talking about how the costs of all those planes might get handled.
I'm sure all being strictly reported in accordance with IRS regulations, no doubt. All right, the IRS has announced a pilot program, no pun intended here, to examine tax returns associated with up to 48 corporate-owned jets. The results of these initial examinations will then determine how the IRS may focus its attention on further examinations. So before we talk about all these tax issues, let's start with some background on the big picture of owning and operating a private aircraft. So Mike, how would you describe the overall scene for federal regulation and oversight of private aircraft?
I appreciate that, Brooks. Whenever clients come to talk to us, their first question, well, because we were kind of joking earlier about bourbon, and as an aside, I usually tell people I'm an aviation attorney at cocktail parties, because if I say tax, they'll snooze otherwise. But they love talking about their planes. Well, normally clients will come to us, especially if they're not experienced in owning and operating an airplane, and they've heard their buddies say, big depreciation, big tax write-offs, or I've got a big gain I need to address, so I need to go buy an airplane. So one of the first things that we talk about before we get into the tax issues, especially federal tax issues, is the interplay of the Federal Aviation Administration and their regulations, as they're vitally important, because how you operate an airplane and how you structure operations can have a tremendous impact on not just on the federal tax benefits you're seeking to obtain, but also whether you're legally operating the airplane in accordance with the applicable law. So I would love to tell you, Brooks, that the FAA and the IRS have similar guidance on what is and is not non-commercial versus commercial operations, but obviously at times they differ. Now, the terms that are kind of thrown around, I'm going to give you and some of the listeners a couple of terms to kind of terms of art to kind of be listening for. The FAA looks at operational control. So at the end of the day, FAA is about flight safety. They're trying to figure out, okay, who legally has operational control of the airplane, where the IRS looks at more what we call possession, command, and control. And as I indicated, there are some differences where the FAA treats, say, an interchange agreement, which is an agreement between two owners to kind of swap use of airplanes. The FAA looks at that as non-commercial, but the IRS looks at that as commercial, subject to federal excess tax. That's just one of the examples. So when we're talking to clients and prospects about airplanes, I always want to know, okay, how are you going to be operating and using the airplane? Are you going to own it in your primary business? That has certain benefits and disadvantages. Are you going to create a special purpose entity? A lot of clients hear from their lawyers, hey, let's isolate this asset, right? Well, how you then manage and most importantly, compensate or reimburse that airplane entity is vitally important on how it's structured from an FAA standpoint, because we want to obviously, we want to maximize our clients' tax benefits, but we want to keep them in compliance with the federal aviation regulations. An example I give to some degree is that carnival game, kids carnival game Whack-A-Mole. Okay. You don't want to solve one problem. Okay. We address maybe some tax benefits, but create for the client FAA issues that could get them into some real serious trouble in the way that they manage and operate the airplane. One other comment I'll make on the FAA side is you'll hear the comments, well, I'm Part 91 or I'm Part 135. Those are references to certain federal aviation regulations that determine what you can and can't do under either non-commercial or commercial operations. Those are also important because the IRS does use those that nomenclature as well when they're talking about certain issues related to aircraft ownership and tax issues.
So, Mike, now that we've got sorted out the FAA rules about how the plane is going to be owned and operated, then we've got to deal with the IRS issues, which can be pretty complex about the use of the aircraft. You want to talk about some of the key issues that the IRS looks at or focuses on in its compliance regulations?
Yeah, even before they announced the new, as Brooks said, pilot program, no pun intended, if you got an audit with any type of aircraft activity, the really big thing for them has always been they want to see the control employee, which is defined as a 5% or greater owner. They want to see that they're paying income tax on their personal use. That has always been issue number one. But the other things that we're seeing more and more review on is things like bonus depreciation, which can include accelerated depreciation, whether it's bonus, which right now is 60% bonus, but for several years we were at 100%. That includes using 5-year makers as an accelerated depreciation. And I'm beginning to see a ton of excise tax audits. Actually, I had 2 clients earlier this year who received federal excise transportation tax audits. And it's bad when you're meeting with the auditor and you're trying to explain Part 91, Part 135, and they're furiously writing down notes. And they're like, okay, I'm sorry, what is this Part 91 you talked about? And real quick, I realized here's someone doing an excise tax audit on a client that doesn't understand federal excise tax. So the other thing I'm seeing is we've got a lot of new and inexperienced auditors. Now, I personally like that because I can teach them the right way to do it and get our clients zero change audits. And then really the other issue is really looking at personal use versus entertainment or business use, because how you use it obviously drives how much of the tax benefits you can avail yourselves of. Another issue I spoke about when I was talking about the FAA is that if you're going to have to use a special purpose entity, then the FAA requires that entity lease the airplane. It cannot operate it out of like a single member LLC, cannot operate legally an airplane from an FAA perspective. So setting up a leasing structure, including a related party leasing structure, creates passive losses. And a lot of times clients don't even consider that this could be a passive activity.
On that lease arrangement. So a lot of landmines in there to navigate through just to be able to use and report that from a tax purpose. So it may or may not have the benefits that a company is looking for, but it certainly has some other use benefits in helping those key executives and those owners manage their business more and their time more efficiently. But that we've talked about the IRS, but those are not the only tax authorities, and you work in our state and local tax team. So can you fill us in a little bit about the state and local taxes that need to be considered also.
Yeah, and if we're brought in early enough in the deal, we can also try to maximize a client's either exemption or deferral of certain key taxes, specifically sales and use taxes. A lot of clients are very focused on the purchase location of the airplane, which is good for sales tax, but they forget what exemptions or deferrals do I have in the state I'm actually going to hangar it in, which is where there's a use tax benefit. So there's various exemptions like resale, flyaway. Some states like South Carolina have caps. We can, if brought in early enough in the transaction, we can plan around some of those issues. Obviously, tangible personal property tax continues to be an issue in certain states. Whether you park it in Louisville, Kentucky, for example, or you park it across the river in Clark County at Clark County Airport in southern Indiana, could be, depending upon the value of the plane, as much of $100,000 a year in additional property taxes. So that, maybe that drive over the river is worth it to save $100,000 a year. We can assist with that.
So let's go back and to the income tax side of this. As you said earlier, Mike, there are really two major issues the IRS focuses on. One is the income inclusion for personal use of the aircraft, and the other one is expense disallowance. So let's take the first one. What can you tell us about the income inclusion rules?
Okay, it used to be in the heydays pre-TCJA, you used to be able to deduct. The company still got a deduction for commuting expenses that were imputed to the employee. So basically, from the imputation of income or income inclusion, any personal use, so it could be personal commuting, it could be going on the weekend to see your child in college, it could be going to get medical services at an out-of-state treatment facility, or it could be personal entertainment. Any personal use of a company-owned asset is going to result in income inclusion. Now, the benefit, one of the benefits is the SIFL rate. Now, SIFL stands for Simple Industry or Standard Industry Fair Level, SIFL. It's put out by the Department of Transportation, and basically what it does is it looks at a variety of factors, including the length of the trip in terms of nautical miles, size of the airplane, how many passengers, how many are there for personal reasons, and it basically runs a calculation that effectively is the cost of a first-class air ticket, which if you've chartered a plane recently, the chartering of an airplane could be as much as $5,000 to $10,000 an hour, where the imputed income that the control employee takes into their W-2 may only be 20% of that. So the control employee does not get imputed the entire expense associated with the use of that airplane. Now, pre-TCJA, the company didn't have to take a haircut on commuting. They got to deduct the full expense related to commuting, and we'll talk about that here in a moment. Now, there's a couple different rules. I won't go into these in detail, but there's a couple different ways you can calculate the personal versus business use. You can do a predominance test. Is the flight predominantly business? And you can do that based on occupied seats. If it's an eight passenger airplane, 4 seats are occupied, 3 for business, then it's a 75% of the occupied seats, predominantly business. Then you don't have to worry about the personal use. So there's a couple of different ways to look at that, and we can assist clients in determining how much income inclusion there is, as well as to do the SIFL calculation.
So that commuting now in our work from anywhere kind of world, if you've got one of your business owners living in Colorado now and they commute to the New York office once a month or a couple of times a month, that commuting to that work location now is going to be count as personal use of that aircraft.
Yeah, it's going to be kind of as personal use, but the bigger issue, because historically it was imputed into income, the company's going to lose the corresponding deduction. So this includes all of at the end of the year, you look at, because we can transition into, what about the disallowance of expense deductions? So what you'll do at the end of the year is the company will look at all of the direct operating costs as well as the indirect operating costs like hangar, insurance, maintenance programs, depreciation, right? And look at all of the expenses, and then they have to take a haircut on the personal commuting or personal entertainment, and they lose the benefit of that deduction. Now, obviously, for business purposes, they get a full deduction for the percent related to business usage.
So if the flight value, the SIFL value that's imputed to the employee is, say, 20% of that $5,000, so $1,000 for a flight, but the expenses themselves were upwards of $4,000, then the company really loses out. The employee is good because they picked up $1,000 worth of value in their W-2. Their out-of-pocket cost would be the tax on that $1,000 value, but the company is losing a deduction for, say, that $4,000 of direct and indirect costs for that flight.
That's correct.
Okay,
that's correct. Yeah, there is a haircut on the expense side.
But if it's a business flight and for business purpose, then all of those, there is no income inclusion, and the expenses are all deductible at that point. So
correct.
Okay, so it is a costly operation to the company owning the aircraft, but it does provide a lot of benefit to the key executives and others who are taking advantage of it.
And there is one minor exception. I'll call it the Taylor Swift exception. If you're traveling on a company airplane for security reasons, then the company may be able to not lose the benefit of the deduction. You still get imputed income. But you generally have to have a safety plan. But I do want to throw that out there because we do have some high net worth individuals that, a safety concern could be an issue. So that's something we could look at.
It's also flying in and out of high risk areas as well. Say you've got a manufacturing facility in an unstable environment and you're trying to get in and out of those places. Yeah.
Yeah, definitely.
Okay.
All right, Mike, pull out your crystal ball. First, tell us who's going to win the Derby, and secondly, tell us what the IRS is going to be doing on their pilot audits. What do you think?
The Derby, I haven't handicapped the race yet, so I'll have to get back to you on that. With regard to what they're looking for is they're going to be looking at flight logs. Okay, they're going to be looking at flight logs, and it's going to be a little bit late at this point, but it's always a best practice is begin capturing. I mean, you've got to maintain the flight logs anyway from an FAA perspective, is begin capturing relatively contemporaneous with the flights what the business purpose is. The service will normally, most clients fly between the same city pairs, especially on their commuting flights. But if you do have business in Turks and Caicos, okay, and you're legitimately going there, or you go to Vegas, right? Cities that just sound to an agent like you're having fun. If you're going there for business, document, and do it relatively contemporaneous with the flight. But that's what they're going to be looking at. They're going to be looking at flight logs and asking questions about the nature of the trip. And that's why the rules of how you characterize a trip on a per seat basis or, a flight by flight basis are vitally important, and why we should be involved from the get-go on these audit issues.
So it sounds like, Mike, that if someone is thinking about this, there is a lot of administrative effort on the front end or record keeping to keep all this straight, to keep the accounting for the costs and the activity straight, to get the payroll straight. What questions would you suggest a business owner think about before they move forward with acquiring a plane?
It is talk to professionals such as myself to really fully understand the interplay between the FAA guidelines, the IRS tax issues and any state and local tax concerns. It really needs to be, and I hate that we use the word holistic. I feel like it's overused, but you really need to do a holistic review because how it is structured is vitally important to get all of the benefits and advantages possible. And there are going to be trade-offs. So talk to a professional who understands the interplay between the FAA, the IRS, and state and local tax issues so that they can maximize your benefits and minimize any shortcomings.
Wow, I think you just summarized the whole podcast in that sentence. But anyway, let's move to final comments. Mike, is there anything else you would like to add? I mean, you just said it all very eloquently there, but any add-on?
My final comment is, even if you're a pre-existing aircraft owner and you may have been using airplanes for years and feel that you're fairly up to speed, it's always good to sort of have a gut check. And we did that with a client just earlier this week. And there were a couple of things they could improve upon to really make, both from an audit perspective, make, I won't say ironclad, but really improve a couple of things. So even if you're a seasoned aircraft owner and operator, you could still benefit from a review of the things that we discussed.
And Sarah?
I still think owning an aircraft in a company has a lot of positives to it. It just means that the company and its key executives need to walk through the guidelines and make sure that they are following the plan. And as Mike said, a lot of documentation. The better the documentation and the more contemporaneously it's recorded with a flight event, the better it's going to be when and if the IRS or a state comes calling to take a look.
And I guess I'll just semi-echo that. As we've always known, if you have a company-owned airplane, you will draw a question on an IRS audit. It'll be at the top of the list of something they're going to ask about, and it's going to be even more heightened, and may draw the whole audit on you just for having the plane. But anyway, so you got it's not for the faint of heart if you're going to own it and be trying to take some significant deductions on it. All right. Okay, that's a wrap on this discussion of tax reporting issues for income inclusion and expense disallowance for company-owned aircraft. A quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Bekaert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe. Thank you, Mike. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.